Thank you all for coming. I'm Marcus Brauchley of the Wall Street Journal. I'm moderating this panel this afternoon. The subject of this panel is perhaps of more immediate interest than may have been when it was conceived. The title of the panel is, "If America Sneezes, Does the World Still Catch Cold?" And maybe the better question is, if America catches some kind of viral pneumonia, where do you hide? The last year has obviously seen some profound changes in the world economy and the financial markets. Last year at Davos, the Michael Klein's boss, then boss, Chuck Prince, said he anticipated a very benign economic and financial climate. It turned out not to have been benign for him or for anybody else. And that may go to show that the value of Davos prognostication isn't worth much. But we'll try anyway on the theory that the folks on this panel are about the most experienced and thoughtful people you could find on matters of global economics and finance, and they will undoubtedly impart some wisdom. I think what we'll do is I will begin by asking everybody a question or so, and then we'll follow up with some conversation and open it up to the floor for questions. And I think that this conversation is an on-the-record conversation. Please, if you ask a question, identify yourself, and please try and keep your questions rather short and to the point. And if you haven't done so, please switch off cell phones. To begin, I'd like to start with Fred Bergsten at the end and ask him for his perspective on the U.S. economy right now, since it really is the locus of so much attention. Fred tells me that he is an optimist relative to the mean, having sat through a session earlier today with Steve Roach. But Fred, maybe you could begin by setting some context for us.
Well, my answer to the question for the panel is that when the U.S. catches cold now, maybe the rest of the world gets the sniffles, but certainly not pneumonia, and I'm not even sure the rest of the world gets a cold either. I believe the world economy has in fact largely decoupled from the United States. Now obviously a U.S. slowdown or recession will have spillover effects and lead to slowdowns elsewhere. But remember that the emerging market economies, China, India, and others, now account for fully half the world by a percentage point or so as a result of the current problem. They are still going to be growing at 6 to 7% as a group. China may slow down from 11.5 to 10. India is not very integrated to the world. It probably won't slow very much. So the emerging markets are still going to provide a substantial growth in the 6 to 7% range this year, I think, and that's half the world economy. That means that even if the industrial world, Europe, Japan, and the United States, drop down into the 1 to 2% range, which is possible, maybe even likely, it still means that world growth is going to be close to 4%. And that's not bad after 5 consecutive years of 4.5 to 5% growth. It means the world economy as a whole certainly is not falling into recession, and means, in fact, that things are much too bleak and pessimistic around here as to the outlook. Indeed, I would go farther. In addition to arguing that the world has largely decoupled from the United States, I believe we're going to experience the first episode of reverse coupling, by which I mean the rest of the world is going to prop up the United States. And this continued reasonably rapid growth in China, in the other parts of the world, will dampen the extent of the U.S. downturn and keep the U.S. from falling as far as most people now think. The mechanism is the trade balance. Over the last year, the U.S. trade balance has improved by over $100 billion. That's more than 1% of GDP. That's more than the decline caused by the housing sector, at least so far. And remember, for the previous 10 years, the U.S. economy was losing a percentage point a year from deterioration of the trade balance. Now it's gaining about a percentage point a year. That is a huge swing from -1 to +1, and a very important dampening factor in the U.S. position. Look at individual companies. The recent reports, Caterpillar, GE, IBM, what are they saying? Our domestic sales are down, maybe 10% or so in the case of Caterpillar. Our foreign sales are up 25% or more. Overall corporate revenues are up, corporate profits are up, reverse coupling, as seen at the micro level as well as at the macro level. So I think we're in a situation now where, yes, of course, the U.S. is going to slow down and may have a recession. But I think the extent of that U.S. slowdown will be more modest than most people think, more short-lived than most people think, because of reverse coupling, because the rest of the world, far from catching pneumonia when the U.S. sneezes, will actually pull up the U.S. and reduce the extent of the damage.
Cheng Siwei, from the perspective on the other side of the world, from one of the largest exporters to the U.S., do you accept Fred's idea that the rest of the world can carry the U.S. economy, and if the U.S. suffers some kind of a downturn, that it can be moderated sufficiently by demand from China or from India, the world won't slide further into recession?
Well, I only can agree with Fred in part, partially, because America as the greatest economic entity, it has a strong impact to the world economy. So what we are worrying about is the economic performance for the United States this year. And it depends, I think, on three things. One certainly is how deep the impact of the subprime mortgage crisis. I think the impact is still there, and they are diffusing now. The second is what's the trend of the dollar? Is going weak or weaker or going stronger? In my impression, the American government has some kind of policy for a weak dollar. I did some research, and in recent years, the money supply, of a dollar is growing. So, in this case, the oversupply of the dollar will make the dollar weaker. And the third is, this year is your election year. So how many effort your government would like to pay to the economic development? So I think these three are very key points. And according to the forecasting of some experts, they predicted the U.S. economy will grow 2.8% next year. It's an optimistic point. And the whole world is 4.8%. I think if we can do this, there should be no serious problem. But if the 3 points I mentioned go wrong, so it will have a deep impact. And for China, as you know, this year we got, I don't have the official statistics, but our GDP is around, I think, 3.7 trillion US dollars. And our foreign trade is about 2.2 trillion US dollars, compared with 1.76 last year. And our surplus is around 260 billion US dollars. That's from our statistics from our side. From the US side, they have a much larger number. And my prediction is in China, as I said last year, we have no intention to persuade a higher growth rate and a larger trade surplus. And so last year, our goal for economic growth is 8%. But unfortunately, or fortunately, we got 11.5%.
Not so well.
No, because I'm working in the National People's Congress. In our plenary session, we voted for 8%. That's because we want to use more resource to build up social security system, to improve the people's living, to cut down the energy saving, to solve the problem of climate change, global warming. But unfortunately, we didn't meet these kind of objectives. We overfulfilled our growth rate. So this year, I believe we will still stick on 8% growth rate. I wish we can not overfulfill it quite a lot. That's the one thing. The second thing is that, in my opinion, the trade surplus in this year will go down. I think will go down, yes. The reason is, now we are under a big pressure of the RMB appreciation. I just give you one number. Last year, our foreign exchange reserve raised from 1 trillion to 1.5 trillion. In 1 year, increased for 500 billion. And in the past years, generally speaking, is 200 billion per year. And last year, we had a big jump of our foreign reserve. And our surplus is only half of them. And the FDI is around $50 billion US dollars. So totally 300 billion. So where comes the other 200 billion? So I just published a paper talk about the excess liquidity in China. And the other 200 billion partially comes from the appreciation of our euro asset, but mostly it's hard money flew into China. So next year we would like to this year we would like to reduce our trade surplus, and we will take a more rigorous measure to ban the hard money. Because the hard money, when the hard money flew in, they will buy the stocks, they will buy the real estate, and makes the stock market and the real estate both booming. It's abnormal. So finally, we have a firewall at this time being. That means RMB is not fully convertible, but it's going to the direction of fully convertible. So the firewall has some leaks, has some holes. So we would like to have as less hole as possible this year. Thank you. Maybe I take too long time.
No, thank you very much. We'll come back to a couple of those points, but just to move on to Michael Klein, who in the course of the last few days has ricocheted between London and New York and back to Switzerland as the financial markets have gyrated. Perhaps you could talk a little bit about what the global connections are in the financial industry. I mean, if Fred is right that there's this reverse coupling going on in the world, in fact, that the U.S. economy and the problems of the U.S. may not be so severe or maybe moderated by the rest of the world, one wouldn't get that impression looking at the markets of the last few days. In fact, one gets the impression that the problems of the U.S. are being transmitted fairly aggressively and with some damage to the rest of the world. Do you see this same sort of, in the financial sector or more broadly, do you see this same sort of reverse coupling?
Well, thank you. And I will speak, as you indicate, as a banker, so perhaps have a bit of a commercial view as well as a market and economic view. I'll make 5 points to response to your question. The first is that I agree with Fred's constructive view, generally speaking, and it's hard not to agree with that. I'll spend a second on that in a moment. Secondly, however, I think the impact of the crisis of July and August this year was far deeper than regulators and central bankers and investors understood at the time. And of course, we are starting to see the implications of that perhaps the most constructive commentary is that there is a much greater recognition today of activity that was actually in place in July or August. Third point I'd make is that what we're facing today is very large secular trends as opposed to what has been defined in many ways as cyclical trends. I'd say fourth, it's very clear that linkages exist, and the concept of who is the driver of the transformation of economic activity, be it one direction or the other, has become an interesting question, but the linkages should not be questioned. And finally, the greatest risk we face is the impact that could occur by knee-jerk reactions to create a disconnect of those linkages. If I can just elaborate for a moment, first and foremost, Fred's comments, I think, are clear. It's hard to argue that when you have 100 countries growing at over 4%, 4 years in a row record growth, 6 years out of 8, 8 years out of 10, when we have the ability to effectively have a growth rate that is so far in excess of what has been trend, that you can have an environment where commodity prices can be at record highs and interest rates and inflation still at record lows. I think that is clear, and it's constructive, and it's driven principally by globalization and liquidity. And without going on at length, I would say the three major trends of regulatory globalization, technology globalization, and finally, after the Asia financial crisis, capital markets globalization, have allowed the final walls between the emerging markets and the industrial countries to fall. And that last wall, which was cost of capital, fell in 2001 or 2002, and now the ability to have low-cost financing, the asymptotic reduction of cost of capital that began in 1981, stopped at the developed markets and has since pierced into the emerging markets, is the major driver. It is our view, it remains our view, that with no barriers in place, 95% of the world's economy has a free flow of goods, services, and capital, which means today that natural advantages prevail, and the two natural advantages are, of course, human resources. And you have two major economies, China and India, bringing 3 billion people into the consumption world, but also natural resources of commodities. And when one looks at it this way, one realizes that the two major secular trends are the transformation of jobs, economic activity, to newly industrialized countries, and the transformation of wealth to the commodities countries. Whatever your prospects are for oil, oil today is a $4 trillion flow of funds, $2 trillion of which go to basically 4 countries each year. $2 trillion is equal to the entire U.S. net income. So effectively, this commodity shift is taking every year's U.S. net income and shifting it to the 4 major commodities countries. That's occurring. Those secular trends are not a stoppable force. The point, however, on liquidity that was not well understood was there was a third trend, which was the financial money multipliers. And one can name them what they are, but the non-regulated, non-bank, undercapitalized financial system, whether you call it asset-backed commercial paper or CLOs or CDOs or SIVs, which was $5 trillion, twice the amount that is now being focused on in sovereign wealth funds, that vehicle structure has been permanently impaired. And it is that vehicle structure which, upon its collapse in August, forced a degree of liquidity that came out of the markets and has to be replaced. And that replacement is now in the process of occurring. Central banks productively providing liquidity, but also banks bringing assets on their balance sheet. And make no mistake about it, if $3 trillion of that $5 trillion goes away, that's the equivalent of funding the new balance sheets of HSBC, Barclays, and Deutsche Bank combined. That's 3 big functions. That's what's going on today in the financial marketplace. That's a tremendous amount of attempting to find new assets in that regard. However, I think that process is working through because liquidity that sits in those 2 main drivers, the industrial countries that cannot invest enough at home and must have continuity with their export currencies, and commodities countries which cannot invest at home, are bringing balance along with central banks to this liquidity flow. Finally, I think the concept that there was a dichotomy, that there would be no impact on equity valuations versus debt, that there would be no impact on emerging markets versus industrial markets, by definition, those absolutes never exist. And today you've seen 40 different countries have equity markets drop by more than 20%, even the most active and most productive equity markets. You're clearly seeing only the beginning of what will be the credit impact. We've only seen the liquidity impact. The credit impact will be economic slowdown. And it is unquestionable that there are trade linkages, financial market linkages, that whether it's a 1.16 or a 0.60 correlation, the major economies of the world are correlated to the U.S. economy in both directions. So if the U.S. economy has a major slowdown, it will impact the rest of the global economy. It will be more moderated, as Fred said. And finally, what will be the most important impact is we always forget lags. And the U.S. economy will find its deepest issue perhaps 6 quarters into, if there is a major issue. Those lags likely will be moderated by all of the timing actions around the globe. This balance that Fred described, recoupling in the reverse direction, will have a fantastically positive impact on the U.S. because it will create a shallow, perhaps more shallow impact. And as a result, we may find that by the time the impact is felt in China slowing or in India slowing, the U.S. has already begun its recovery period.
Thank you. David McCormick, we're hearing some fairly benign medium and long-term assessments of linkages between the U.S. and the rest of the world. But in the short term, I think there's probably a lot of anxiety about the financial markets, about the stability of the world economy, about the prospects for growth. How do you see those things evolving in the short term, perhaps instead of the long term? And how do you think that we should see regulators and the relationship between governments in times like this? Are they sufficiently aware of the highly diverse kinds of instruments and structures Michael was talking about? Are they sufficiently aware of these that they are taking the steps that would ensure long-term growth?
Yeah, just a quick word on the U.S. economy. I think I generally would agree with what Fred and Michael both said, which is that the U.S. economy has sound underlying fundamentals. There are clearly areas of concern that we've seen play out over the last 4, 6, 8 weeks in a much more significant way. And while we continue to believe the U.S. economy will grow, there's no doubt that it'll grow at a much slower pace, and that the downside risk has increased. Which brings us to this question of decoupling and your specific question. And I think maybe reframe the question. It's not a matter of decoupling or not decoupling. It's a matter of degree and where. And what's been driving the downturn in the U.S. economy really comes down to 3 things, or some of the challenges in the U.S. economy. One, first and foremost, has been the housing downturn, which, as it's played out, I think has proven to be far more significant than was initially believed. The second is the subprime market turmoil, which has expanded well beyond subprime, well beyond the United States, into a broader repricing and retrenchment of risk. And then third is a broad-based increase in commodity prices, particularly in oil, which is also an incremental penalty on growth. So that combination of forces is putting additional pressure on the U.S. economy, which we're seeing reflected in the numbers. And when we come to the decoupling question, I think 2 questions that precede that. For decoupling, that thesis to hold true, there would need to be 2 conditions in place. One would be that those 3 forces are isolated to the U.S. economy, exclusive to the U.S. economy. And the second would be that whatever economic downturn and slowness we have in the U.S. economy, that the growth in the emerging economies would offset that. And so let me talk about each of those briefly. In terms of this being isolated, I think we've seen that while the housing market's primarily been in the U.S., I think we see signs of potential housing market challenges elsewhere around the world, but that's primarily been a U.S.-focused thing. The subprime and repricing and retrenchment of risk has taken place across global markets, and we see that even in the last couple of days in terms of repricing of risk in the equities markets. And the commodity burden that we all feel in our economies is shared by all that are represented in this room. In terms of the ability of the emerging economies to offset a slowdown in the U.S. economy, I think there's just much to celebrate here. As Fred said, The emerging economies now account for half of global growth. It's a great story, and one that certainly will minimize and lessen the impact of a slowdown in the U.S. economy, but not completely. The U.S. still is 20% of the global economy. It accounts for 30% of all imports. It remains the 800-pound gorilla in the global economy, and as a consequence, as the U.S. economy slows, we will see that reflected in economies around the world, and we already are seeing that reflected in leading indicators in economies around the world. I think in the last 3 to 6 months, you have seen a growing focus and improved understanding among regulators around the world on some of the specific issues that have been raised here in the subprime situation. You see a collaboration to really think about the appropriate policy response through the Financial Stability Forum, which has brought together central bankers and a variety of regulators as well as finance ministries to really focus on a number of different areas where the subprime situation has shown that there may be holes in our overall country as well as global responses. So I think that those bodies are working. They were informally working initially, and I think now they are formally working, and I think that as a consequence of this, we will see policy responses that are focused, targeted, and I hope effective.
The journalist in me requires me to ask, Cheng Siwei said that he thought the American government has a policy for a weaker dollar. Does it?
I thought we might just skip right over that. Yeah, the long-standing policy of the United States, and one that's been re-emphasized to me on a number of occasions, is really only the President and the Secretary of Treasury speaks on the dollar.
Great disappointment here in Davos.
Can I comment on it?
Sure, Fred.
That's about the official,
Just a point of view.
David showed admirable restraint, and as a purely private citizen, let me just suggest that one reason for my optimism about the reverse coupling and the impact of the rest of the world in limiting the U.S. downturn is because of the dramatic improvement in U.S. international competitiveness, because the dollar has already declined a lot. There are two factors. The continued rapid growth of the rest of the world is, I think, the dominant factor that will keep demand for U.S. exports rising sharply, and we've already seen it in that big improvement in the trade balance over the last year that I mentioned. But in the period ahead, the big improvement in U.S. price competitiveness is a huge issue. The dollar has come down by a trade-weighted average of about 25% over the last 6 years. That dollar decline has been gradual, it's been orderly, it has not disrupted the world economy, and I think it's still got probably another 10% or so to go, because though the deficit is coming down, it's still quite large. It's still more than 5% of GDP. It's still too big to be comfortable. So there's an important, so I think the U.S. competitive position is strong and will get stronger, and you might even say the U.S. is now going to be experiencing export-led growth. That's the other way of putting my point about the reverse coupling. I wanted to say one word about my Chinese friend's comment. He gave the very optimistic forecast that China's surplus will come down this year after they added $500 billion of reserves last year. Now, that would be a whopping turnaround from such a huge increase in their reserves to an actual decline in their surplus. The forecasts I've seen, based on China's own numbers, suggest to me that China's surplus is going to continue to go up. Not nearly as much as it has in recent years, but still, on the Chinese numbers I see, China's current account surplus last year, 2007, was about $400 billion. That's the current account. This year it'll go up to maybe $450 billion, headed toward $500 billion next year. That means China's global surplus is becoming almost as big as America's global deficit. And that means the Chinese imbalance is right up there with the American imbalance as a source of difficulty for the world economy. But notice what it means for the world economy, the rest of the world. If the U.S. deficit is coming down significantly, and the Chinese surplus is still going up significantly, that's a lot of pressure on the rest of the world, because those two things combined mean that the current accounts for the rest of the world have to deteriorate another 150 billion per year or maybe more. And that, coming on top of the troubles we're talking about, is going to put pressure on the rest of the world. So to that extent, there's still obviously coupling, there's still obviously an interactive effect. I would note one other thing to my friend from China, perhaps to ask him to respond. About 2.5 years ago, China announced a change in its exchange rate policy to pursue, as it said, greater flexibility of its exchange rate. At that time, as he pointed out, China was accumulating reserves, about $200 billion a year. They were intervening maybe $20 billion a month. Last year, they intervened about $50 billion per month for the reasons he indicated. By that metric, China's exchange rate policy is only 1/2 as market-oriented now as it was when they announced the more market-oriented policy 2.5 years ago. So, in order to achieve the objective of reducing the current account surplus, what policy changes are coming in China?
Oh, well, first, I must announce I'm working the National People's Congress, so I'm not speak on behalf of the government. You know different between the Congress and the government, okay? And I'm a scholar, so I speak just based on my own research. To answer Fred's question, yes, actually in the Asian financial crisis, during the Asian financial crisis, I put forward a 3-step strategy for China's foreign exchange policy. If you had my book, you can see that. First is pegging to the dollar, basically pegging to the dollar when the dollar is strong. And secondly, we will shift from pegging dollar to pegging a weighted basket. And the third is to let RMB fully convertible. So 2.5 years ago, actually in the in July the year 2005, we changed it. We went to the second step. That means from pegging to dollar to refer to a basket. What is the difference between pegging and referring? Pegging is more transparent, but less flexible. Referring is less transparent because I don't need to tell you what currencies in my basket and what's the rate for each, what the weight for each currency. So it's less transparent, but more flexible. That's the difference. So we changed to refer to a basket.
Could I ask, though, the renminbi has gone up about 15% against the dollar since that time. Yeah. But since the dollar has gone down about 15% against everything else, the average exchange rate of the renminbi has not gone up. And so the Chinese surplus has gone up as your competitive position becomes even stronger.
But the reason is, our foreign reserve, our trade surplus, and our foreign debt and foreign FDI is mainly based on dollar. So the dollar has a great weight in the basket. So in this case, you cannot expect a rapid, growth of that unless we changed the basis of clearance, of foreign trade clearance. But it takes some time, it takes some time. So that's the problem. So I think from that time, the RMB from 8.35 now to less than 7.3 now. So we are appreciating RMB slowly and gradually. And it is I think it's good for the Chinese economy and also for the world economy. If we take some kind of a very aggressive policy, it will be a disaster. That's my point.
This is as you referred to earlier, Mr. Cheng, a difficult year in some ways for the world economy because of the U.S. election, and U.S. elections have a way of complicating economic policy. With the imbalances as grave as they are, and with anxieties, economic anxieties as acute as they are in the U.S. Because of recent financial market movements, what do you think, I guess I'll throw this both to you and maybe to Mr. McCormick, what do you think the prospects are for some kind of protectionism or any kind of legislative or administrative fiat that would impair global trading at this moment?
Yeah, I mean, the U.S. policy has been very consistent for the last several years on this, which is that we believe that China needs to move much more aggressively to a market-based currency. As Fred said, there has been some progress, and in the last 90 days, in particular, the pace has increased dramatically to something along the lines of 15 or 16% annualized relative to the dollar. So there's been movement, but that accelerated pace needs to continue, in our view, not only to the benefit of the rest of the global market, but to the benefit of China.
Can I interrupt real quickly? To go back to Fred's point, 15% against the dollar, but is it important to the U.S. as well that it should appreciate against the basket?
Yeah, so it should be against a trade-weighted basket as well. So that was my second point. It needs to be a much more broad-based appreciation across a broader set of currencies at an accelerated pace. But one does need to acknowledge that in the last 90 days in particular, there's been real movement that we hope continues. In terms of protectionist legislation, I think if you looked at challenges to the global economy more broadly, not only in the United States but around the world, I think one of those that jumps out most is retrenchment from the global economy and protectionism taking place, and you see little signs of it around the world, and that's one of the areas that we're most focused on pushing back on in the United States, and I think that there are many members of Congress who recognize that. So I'm hopeful that we don't have punitive action taken, because I think it would set us back in terms of our relationship with China, but also within the broader debate about the benefits of openness for investment, openness for trade, openness for markets.
Well, actually, I think one evidence is clear. RMB now appreciated by 15%, but our trade surplus is still growing. So I think there is at least less correlation between the RMB appreciation and the trade surplus. This is the data. On the other hand, I think the major problem is how can we find a way to cooperate instead of, to put pressure on us on appreciation of the RMB. So actually, last year I said, if the United States can sell more products to us, high-tech products to us, it will improve the imbalance greatly. Just for kidding, if you sell a space shuttle to us, the imbalance will improve quite a lot, but you won't, right? So in this case, as I said, we have no intention to persuade a larger trade surplus. It's really a big burden to us. Please help us to solve this problem, right? Just sell more, things to us, right? And cheaper than China, made in China, and better quality.
Maybe raise the prices.
Well,
put the market to work.
I just read a book, Living Made in China for 1 year, written by an American. He made up his mind, don't buy Chinese goods for 1 year. But finally, he got the conclusion. His spending is increased quite a lot. So he gave up. After 1 year, he back to the made in China. So don't blame us for the cheaper goods. But on the other hand, why I said this year the surplus will go down. The one is because the cost driven, the oil cost, the land cost, the labor cost. We just passed our labor contract law. It will add, more cost to the labor cost. So in this case, the price of Chinese export goods will increase, and in this certainly, the export will go down a little. So that's my point.
Two quick points. On the correlation between the exchange rate and the trade imbalances, one always has to remember there's a lag. It takes 2 or 3 years for a currency change to play through to a trade balance change.
But now after 2.5 years.
Well, no, but you see, as we've agreed, there has been no increase in the trade-weighted average of your exchange rate. So it would be hard to expect any reduction in your global surplus because there hasn't been any increase in the value of the currency. The correlation is certainly working in the U.S. case. As I mentioned, with the lag, the U.S. deficit is coming down. The other point I wanted to make, put in an unpopular word perhaps, of defense for the U.S. Congress, because, Mr. Chairman, you raised the question of protectionism. I talked to some of our congressional leaders last week. They're actively considering legislation in this area. But I think it's fair to say they fully recognize that taking action of that type at this time, with market turmoil, economic turndown, might not be the best timing. So I don't think we should expect any imminent action from our Congress that might further unsettle markets, and I would give the congressional leadership credit for that. The other point to make, and it's not widely recognized, if you look at the bills that are now actively being considered in our Congress, they are not protectionist. There is no import surcharge like Senator Schumer was proposing a couple of years ago. That's all been rejected. What they are talking about is trying to find measures to bring pressure on the Chinese currency, that is true, but to do so in ways that are not inconsistent with the rules of the WTO. So they're talking about broadening the definitions for bringing countervailing duty cases or anti-dumping cases. This is an area that is covered by the World Trade Organization rules. Those rules have never been tested, so one doesn't quite know how individual cases would work out. But I think it is important to keep in perspective when thinking about the issue that the legislation now being considered is not what at least most people would call protectionist. I would certainly worry greatly about any really import barriers that were being raised in this or any other context. But I think our Congress has come a long way, is now much more understanding of the real imperatives of the situation and difficulties, international norms that they should not violate. So I would be less concerned about it now, though I say, even there, I think they'll go slow at this point in time, given the delicacies in the markets and the financial risks that would be generated by any new steps, even if they were incorrectly perceived to be going down a protectionist line.
Michael, you want to talk respond for a second, but if you could also maybe address in your response the prospect that there will be a backlash against financial globalization as a result of recent events in the markets.
Thank you. I think that when we get through this period, however long this period is, of financial market volatility and expectations of economic slowdown or recession, whichever ends up being the final technical term, we will wake up and realize that the issue we're just discussing is still the big issue. And that is that we are living in a period where the transformation of wealth and the transformation of industrial activity is going at a pace that none of us in any of our lives or our families' lives has ever experienced. The magnitude of job changes. Yes, the U.S. has fantastically low unemployment, but the U.S. has lost 22% of its manufacturing jobs since 2000. Those jobs, even with the dollar move, don't have a high likelihood of coming back given the current structure of the economic activity. The formation around what is, as you asked the question on financial markets, the formation of industry and finance is shifting to a major question with regard to not simply governance, but ownership. And what is that? Today you have some of the largest companies in the world at an increasing pace housed, owned, and certainly principally operating in non-democratic countries. And that question continues to come forward. The non-democratic, where democracy and capitalism have historically been 100% linked. But the non-purely democratic countries are growing 3 times more rapidly than the democratic countries. They now are 50% of the value economic weighted of the democratic countries, up from 10% in 1990. Now, that may mean very little, but what it does mean is you've got very large companies that are existing on a playing field, that there are just differences of opinion from the standpoint of regulatory bodies. One of those very clear questions is the definition of state-owned enterprises as opposed to investment funds. What is the difference between a rational investment fund and a state-owned enterprise? And should a state-owned enterprise be treated differently? Are privatizations that occur in the newly industrialized markets similar to the Thatcherite privatizations that were so successful in the UK? And in many ways they are, but in some ways there is not the same stated intention to have them fully divorced from the state. So when we emerge from this current period in the market, I think there will continue to be questions as the shift in wealth and the shift of industrial activity and the shift of ownership and the shift of valuation migrates out of home ownership of the existing principal developed countries. Now, how we all react to that, both as investors, as corporate executives, as financial services players, and most importantly as regulators, will be critical, because the market today is completely intertwined. The ability to create walls that would stop the flow of capital and or the flow of goods would have damages that are so far greater than are perceived. Simply put, today, the concept of not capturing, either through ownership of treasuries or ownership of U.S. equity securities or U.S. debt, the flows that come back from the newly emerging countries would be a dramatically negative shift in liquidity into the United States, of course at a time where liquidity is essential. Will there be a backlash? I think there's questions emerging each and every day on pieces of the process within not just financial but industrial activity. We've seen that with the restructuring of CFIUS legislation. We've seen this in comments in Europe on U.S. rating agencies and or U.S. financial regulation. We see this consistently, and I think what needs to be quite vigilant on all market participants, all industrial players, all consumers, investors, but in particular in governments, is making sure there is a clear understanding and there is not the rhetoric that throws the baby out with the bathwater. And we see that quite frequently occurring because of a lack of understanding. And that is something that I think is quite clear, in particular with some of the recent fund-based investments which are carefully constructed. I would make an argument today that the greatest single benefit to the longevity of the U.S. financial structure, and quite frankly the UK financial structure, is the investments recently made by foreign wealth funds into the banking system. Why is that? Because for the past 3 centuries, financial systems infrastructure has always followed the creation of new wealth. London was formed when London became the center of global colonial wealth. U.S. from 1900s onward became the center of and all of the infrastructure, the New York Stock Exchange, the major financial services firms, the major money center banks. The debate on New York, London was an interesting competitiveness debate, but not quite relevant. The real question is, if you thought that the new centers of wealth would attempt to completely recreate the technology and financial infrastructure, you might ask a different question of competitiveness. Now, these investments, which make it's very clear that with globalization of technology and globalization of travel, one need not physically migrate the exact corpus of an exchange to a new economy to get the benefits of both best-in-class technology. So the investments in the NASDAQ or the LSE taking place out of Middle Eastern vehicles, the investments in many of the banks and broker-dealers. This gives a dramatic incentive to keep the financial system that has been so strong in the US and in the UK and grow that with vibrance and utilize that technology and intellectual capital on the global scale without the need to recreate it in a country that might have great wealth and 600,000 people. In my view, that is a fantastic benefit in the long run to the US, to the UK, to Europe, which is not quite understood. And I think if there are backlashes, it will come from lack of understanding and current political processes, which one would hope that better minds would prevail.
David, on that subject, can you maybe illuminate for us the different ways in which government or people in Washington perceived the Dubai Ports deal and the investments in financial institutions?
With regard to the Dubai Ports deal, I was not at the Treasury at the time. I was actually in Dubai at the time that whole thing blew up in another job. And I guess the comment I'd make was just how interesting it was to look at that transaction through their eyes, through the eyes of the folks in the Emirates who had viewed the United States as really the bastion of open investment. And so fast forward to our current situation, and I think our policy starts with the premise that open investment is a critical driver of the U.S. economy, of our prosperity, of jobs in the United States, and we need to maintain that open investment environment at all costs. The President made a statement in May along those lines. There's been a number of ways we've tried to reinforce that message, with most recently the new law that was put into place, the new CFIUS law, which actually I think is a very good step in that direction. Sovereign wealth fund investment has had a long history in the United States, and that history has been largely one of long-term, commercially driven, stable investors. And that's been the history of sovereign wealth fund investment as a general rule. And so without commenting on any specific transaction, that investment's been a very positive force in the U.S. economy. The growth of sovereign wealth funds and the number of transactions raises some legitimate questions. And the questions, in our view, should be very much around how do we ensure that that growing investment in the future continues to be commercially driven and in no way diverts to politically driven objectives. And so the best approach for that in our mind is to develop a set of best practices through the IMF in concert with these sovereign wealth funds to ensure that there's sort of a baseline of what best practices can and should be.
Mark, can I add just one word on that? Having defended the U.S. Congress, let me now give a word of criticism. I talked to a lot of the members about the Dubai Ports World flare-up after it occurred a couple of years ago. And it was stunning how many members of the U.S. Congress did not realize that the United States is dependent on foreign capital inflow to keep our own economy going.
That's encouraging.
Michael made the point that people might have misunderstandings, and this is a critical case in point. They were willing to sound off and politicize an issue that seemed to be appealing without actually realizing that the United States is a debtor country. Congressmen don't think of it that way, even though every year they vote the budget deficits that contribute to our being the world's largest debtor country. But they don't think of it that way. And they don't realize that we need $6-8 billion a day of capital inflow to keep our economy floating. Since the Dubai Ports World case, they have, of course, been educated to that. The Treasury and the U.S. government's done a good job. We from the outside have tried. And you have not seen that repeated, despite some cases coming along that might have generated a similar reaction. So in my defense of the Congress at the moment, it's partly because they do now have at least a bit better understanding of what's going on, a recognition of, yes, U.S. dependence on the rest of the world, the kind of reverse coupling I talked about in the financial side, where we need the inflows, including from the sovereign wealth funds, in order to help recapitalize our banking system and to keep our economy afloat and to minimize the downturn that we're now experiencing. I think that is now much more recognized, and that's one of the reasons that I'm a bit more optimistic that we will not get a negative and protectionist backlash even as the economy turns down and despite the obvious increase in capital inflow from foreign sources that are in part government-owned.
Why don't we open the floor to questions? If you have one, please stand and raise your name. And yes. Right here.
Uday Kotak from India. The question is, if you look at the shift of the financial flows right now thanks to movement of capital, that is oil, which is Middle East, oil and natural resources, which is Russia, and China's exports ability. Global capital is basically getting highly concentrated in these three parts of the world, Middle East, Russia, and China. What kind of an imbalance will it create and actually decouple the world in a very different way?
Is that aimed at anybody in particular?
Maybe Mr. Bergsten.
Well, there's always a danger in concentration in any markets. Diversification is to be desired, but given the pile up of wealth in those sources right now, there's no alternative in the short run. But I think it points to one aspect of the global imbalances that we've talked about. The world energy prices are much too high, and that's adding excessive buildup of financial resources in the oil exporting countries. We've had a dialogue here about China's trade surplus. I would argue that the sooner the better to achieve China's objective of bringing that surplus down so as to diversify the surplus side of the world equation. I think what you say is a good way to emphasize the need for correcting the big global imbalances. Remember, at heart, these are real imbalances. The oil price, the trade imbalances, the financial consequences that you point to add another dimension to it. But they are not the drivers per se. They are reflective of underlying imbalances in real economic relationships, and it's those which policy has to address in order to avoid an untoward financial spillover.
I think, if I would add, the size of the commodity flows are obviously extremely large, and one can't wish or just simply hope those away. Those are facts. There's a demand base for these commodities, and there are suppliers of these commodities. And until the non-commodity producing countries put in place long-term plans to either alter their use of those commodities, this is a fact. And I think that's, as with anything, it's important to deal with those facts. Now, the question then becomes, how does that capital get put to use? And in many respects, it's better to have that capital come back productively to economies that have spent the capital for that. Secondly, are they being put back to work following the existing rules? The U.S. has a fantastic set of rules, as does the U.K., in terms of financial markets and investments and governance. And those rules, quite frankly, protect any investor relative to any other investor, regardless of where the capital comes from. And they do require very good transparency and disclosures, and I think they are and have been quite trusted sets of rules. Third, I think those pools of capital that are forming, at least in one person's opinion, by and large, are following an extraordinarily rational program, which is they're taking a view that in the long run for their own economy, they're diversifying from that which is a depleting resource to that which can be something that can build long-term productivity for their citizens. Norway is a fantastic example of that, and there's nothing wrong with that. It's something that should be in the mindset of all those governments in that regard. Now, when a country that has that wealth goes and hires best-in-class investment professionals, as one of the larger funds is rumored to have hired 1,300 best-in-class professionals, when they outsource 75% of their capital to proven existing money managers, and when they are prepared to not only disclose their stakes, but live by very clear sets of rules with regard to the investments they make, I think when one looks at all those things, one says, that's a very welcome event. And that's a very clear and positive event. And given the current status of demand-based need for commodities and that which are countries that produce them, there is no better option at this point in time. Because having the capital not recycled into the financial system, well, I don't think I'd want to think about what the impact would be.
Could I add just one factual point? I agree with everything Michael said. I think that was very well put. The questioner mentioned Russia. And as part of the real adjustment I was talking about, we may get a lot of help from Russia. Russia's been running current account surpluses the last few years, 7, 8, 9% of GDP. If you look to the next year or two, that may reverse dramatically and even move into deficit, because Russia is now implementing a very ambitious set of fiscal and monetary stimulus programs to try to boost domestic demand growth. Russia's real adjustment, if that occurs, could be $100 billion at annual rates. They may even overdo it a little bit in terms of pumping up domestic inflation pressure. But that's the kind of real adjustment that's necessary. Instead of relying on expanding trade surpluses to expand domestic demand, run down the external surpluses, stop the buildup of foreign exchange, or even reverse it, that's the kind of real adjustment. And it just turns out that Russia, which is a very big player in this, may actually be making quite a positive contribution to the global position over the next couple of years.
All the way in the back, against the wall.
Thank you. Jacob Frankel, AIG. I would like to make two related points. First, lots of attention was given to the exchange rate of the dollar renminbi related to the large deficit that the US has vis-à-vis China. I just want to remind us that at the very same time, China has a large deficit with respect to the rest of Asia, and which means that the focus on this multilateral issue that comes from a bilateral exchange rate may be putting us in the wrong place. And let me make a related point, which is the fundamental disparity today is the fact that China saves about 50% of its GDP, and the US saves about 10% of its GDP. This gap cannot be closed with an exchange rate change in and of itself, definitely in the orders of magnitude that we are talking about, which in turn means that we should really focus the attention to what needs to be done. If you don't like the current account implications of the large saving disparities, what needs to be done to reduce these saving disparities? In my book, I would ask, what do we need to do to reduce Chinese saving rate? And I would say, definitely China does not have social security system, pension system. The one-child policy means that parents cannot rely on their children to take care of them in old age. Of course, they save. Well, develop financial markets, including secondary markets, to enable you to secure the future by saving less and yet making a good future. The other side of the Atlantic, the same story. In the US, what needs to be done to raise the savings? Maybe what happens in the housing market today is the beginning of it, but I think rather than talking about the exchange rate, I would go more to the fundamental issues.
Right. I think that's a good point. I also think the U.S. savings rate is closer to 1% than to 10%, right? Oh, I'm sorry. Right. Let me maybe direct the question, turn it into a little bit of a question. I mean, what can China do? What should China do to reduce its savings rate, maybe to increase domestic demand?
Well, what we are going to do is to encourage people to spend their money. You know,
that's to give it to them.
Actually, Premier Zhu Rongji said, you know, to spending your saving is patriotic. You know, so you should spend your money. But the problem is, first, you know, the Asian people, generally speaking, has a tendency of saving their money. So the Chinese save today's money for tomorrow, and the Americans spend tomorrow's money for today. That's quite different, right? And the second is we would like to promote the consumer spending. At this time being, the consumer in the debt structure of our banking, the consumer loans is only 12.6% of the total. And I think in the United States, maybe over 70%. That means we need to encourage people to borrow money from the bank, or at least don't save the money in the bank, right? The second thing. The third thing is we would like to encourage people to invest. We announced the policy is to increase the asset income of the people. That means we encourage them to buy stocks, to buy governmental bonds, and we are going to have our the stock index market. It's almost mature now. I think maybe in in this year, we will have our stock index market, and also we have a future market, and we are going to have our second board of stock market, like NASDAQ in China this year too. So we encourage people, don't save your money in the bank because the interest rate is very low. So please take your money to the capital market. So I think that's what we are doing now. Actually, I don't want to debate anymore with my friend Fred. Next January, let's wait and see. Okay. Next January, let's wait and see. I will bet with you with that. And also, actually this year our policy is very clear. We will try our best to prevent our economic growth from a fast growth to overheat, to prevent the price raising of some consumer goods to inflation. So these are two major economic policy for us this year. We already announced. So in this case, we will have a tight monetary policy and a robust financial policy this year. So I believe this year our economic growth rate will be lower than last year. That means lower than 11.5, even lower than 10%. Our trade surplus will be lower than last year, maybe 20 to 30%. That's my prediction, my guess, But that's why I dare to bet with you,
Just
okay.
I can't resist saying that when you put your focus on countering inflation, one of the most effective policies to do so is a stronger exchange rate for your currency.
Well, this is only one side of the coin. But on the another side, you will see if we appreciate RMB quickly, it will bring a profound impact to the world economy, especially for the Asian countries as well as to the American people. You will spend more for Chinese goods, right? And we will buy cheaper raw materials from the Asian and African countries. Is that good? I don't think so. So our policy is slowly appreciate RMB until it reach a reasonable foreign exchange rate.
Sasha,
I don't know if you agree with me or not.
in the front row here. Sashi Tharoor.
Shashi Tharoor from India. It's obviously been reassuring to hear that if America sneezes, the rest of the world is more or less immune from catching a cold. But one word we haven't heard in this discussion is the word outsourcing. And in an election year, with the current political climate, at a time of economic trouble, with Lou Dobbs ranting on CNN and so on, I wonder if any of the American panelists would like to speculate on the risk of a serious political backlash against outsourcing, because if that happens, that's a virus that can cause pneumonia in places like India.
Sure. Yeah, I would just By the way, I don't think that on your first point that that the decoupling thesis was accepted. I don't think that was accepted certainly not by me. I think there is some coupling that still exists. You know, I just would go back to my earlier remarks. Whether it's outsourcing, the question around outsourcing, whether it's the free trade discussion, whether it's the open investment discussion, I think that we have to take particular care in the United States in this year in particular, in this election year, that we do not let the question of openness and a retrenchment of openness go unchallenged, and that the case for openness in trade, in investment, broadly speaking, I think is well documented. It's undeniable, and there are certainly dislocations that result as a consequence of it that need to be addressed from a public policy perspective. But the base case for openness is sound and one that we need to continue to promote. So I hope not. I hope it doesn't become an issue. There have been some worrying commentary that have come out from various candidates on both sides. So I think we need to be very firm in advocating openness across all those dimensions.
I might just remind, in a small way, the great benefit of the U.S. economy is it is immensely flexible. And that flexibility means it has fantastic self-healing benefits, which I think is dramatically better than virtually any other economy that doesn't have that degree of freedom and flexibility. It not only encourages innovation and technology, but rapid response. Just consider, it took 15 years for one of the major economies with a significant banking crisis to come to grips with the trouble of loans on their books over 15 years. The commentary that's gone on for U.S. banks has been, how quickly can you disclose the magnitude of your problems in a matter of days, weeks, quarters, and then raise capital around that. There's a fundamental difference embedded in that. What is that fundamental difference? Just in the financial space, leverage ratios for financial firms are 15 to 20 times, which means if you have $1 of capital, you get to provide money and to stimulate the economy and fund growth for individuals or for companies. The willingness to move quickly and respond and be flexible, both within the government, within the financial system, within the companies, that is the fundamental great core strength of the U.S. And it means that while there may be events that occur that cause issues, they're visible, they're clear, they're transparent, they're dealt with, they're put behind, and they move forward. That does not occur in many other economies with the same way. And as a result, the likelihood of rapid recovery, as opposed to 10 to 15 years of deflation, is a dramatic difference. And I think outsourcing is just a piece of what is a general accepted theme of how one adjusts to workforce questions, workforce issues, in the same way as capital and other responsiveness. And I don't think we, in this panel, but more broadly with this question of the U.S. and what happens next, I don't think we give enough credence to that speed from a government straight through to the market-based professionals.
Just to echo and amplify briefly what Michael just said, one very important reason for that greater flexibility that he talked about has been the rapid globalization of the U.S. economy over the last 30 years. People don't realize that the share of international transactions in the U.S. economy has tripled in the last 30 years. The U.S. is a more open economy than the European Union as a group, much more open than Japan, and that leads to some of the differences Michael mentioned. We've calculated at my institute that the U.S. economy is now $1 trillion per year richer as a result of the trade globalization of the last 50 years. There are some adjustment costs, but the benefit-cost ratio is 20 to 1, and it's been a huge element in generating and maintaining that greater flexibility. And that's why all of us are so worried that any backsliding from that would be a huge cost to the U.S. and to the world as a whole.
I think we have to wind up here. I think the panel has generally concurred that if there is, rather than there being decoupling, there is a kind of, I guess, what Fred called reverse coupling, where there is correlation that is both negative and positive, but largely a moderating force at times of difficulty. And I think that's a somewhat encouraging finding given the state we're in right now. I guess we didn't address the issues of how long and how deep the current financial-driven crisis will last, but we'll at least get a chance to see in coming months whether it ends up being more profoundly negative or moderated by this reverse coupling. Thank you very much for coming.